Hello, hello, hello. What's going on, everybody? Welcome to a capital hungry higher time frame macro analysis webinar. So, for those of you who are new here, well, if you're new here, you shouldn't maybe be in this webinar. You should be watching the educational webinars. But anyways, for those of you who are maybe new to the capital hungry process, every single month, at least twice a month, or especially closer to the end of quarter periods, we like to do a higher time frame analysis webinar. This does a few things for us. It allows us to almost mentally reset, zoom out, get out of the day-to-day noise of people who are primarily scalpers or day traders just stuck on the hourly and lower time frame charts. It helps us get a better, more objective picture of long-term trend and main macro fundamentals that are impacting the market, and more specifically, the asset classes that we trade. It also helps us gauge potential projections of what's to come based on historical repetition, price action, key price points of interest, and so forth. So you can get a really, actually, I really do suggest this to anybody, maybe if you have free time in the future, or if you're ever bored looking to expand your knowledge and skill set overall. I would highly advise, especially over the last year and a half, watch all of the macro higher time frame webinars. You could probably go to the main feed, or like obviously on Telegram, the main feed channel, or you could just go to the Capital Hungry Vimeo and search within the Capital Hungry library, where if you just search higher time frame webinar or macro analysis webinar, the whole collection should probably get pulled up there. And if you watch those, especially from like a year and a half ago on to now, you can pretty much see how we were projecting dollar domination, gold sells on the higher time frame over the last like 9 months here, playing the GU sells, Euro USD sells, not getting shaken out by the market waves, and obviously understanding some of the historical repetition and impacting of fundamentals. So it's always good to do if anybody's ever bored or looking to learn more. Anyways, so leading into what we're discussing today, of course, for anybody who has been following along, the main macro information advantage on a global scale that we have been playing is the central bank monetary policies, and of course, how much weight that holds in the current economic cycle of seeing global recessions, less economic and investment activity, and so forth. So to summarize, and let me talk about some key events here. Now, this is number one, right? Central bank monetary policies, major CBs moving out of accommodative phases, which for people who understand, these accommodative phases or phases of relatively low interest rate that we saw, and of course, more money stimulation and pumping into the markets, it happened in a very accelerated, aggressive fashion during the pandemic, but it's been like this for a decade plus. It was just extremely aggressive and put into the spotlight, put into center stage during the pandemic because it happened at such an accelerated and exponential fashion. But interest rates have been relatively low, near zero, which provides almost essentially a lot of free money to the institutions and banks and corporations down the line. And it is what is called the free money decade. So major central banks, which we'll talk about, like Bank of England, of course, Euro Central Bank even starting to see coming out of negative rate hike territory, Bank of Canada, Reserve Bank of Australia, Reserve Bank of New Zealand, and the Feds, majority of them, because inflation has gotten so high during the pandemic phase, that was obviously man-made, and we've discussed that many times. A lot of them are coming out of accommodative phases. So major central banks hiking rates, right? Except BOJ in this situation of the major central banks that we look at, keeping monetary policy loose. So this is all pretty much like step number one, and everything sort of starts to stem out from here. But then you look at the ripple effect that these overall moves have. Global central banks raising interest rates and coming out of accommodative phases as a collective is okay, obviously, as they need to bring down and combat inflation. And you're going to see that this leads to this overall collection of catalysts. From an individual basis, GBP, AUD, USD, Euro, and CAD strength. Just initially, we're going to go by it step by step. For people to understand global reserve currency, one, it's that majority of other countries in their reserves primarily hold the US dollars as an emergency point. And two, it's also the global business currency, where majority of business is denominated on an international perspective, from import to export to the crude oil and selling of oil around the world. It's primarily denominated and sold in US dollars. Yeah. So these currencies, GBP, AUD, like any of the smaller ones outside of the dollar, when we look at the overall currency crosses and pairs that we trade, right? So these catalysts here of just the main macro higher time frame advantage, the cartels of the currencies coming out of the easy money era, when you're looking at the main central banks outside of the Bank of Japan, their majority hiking rates. This does bring, when you're just looking at the impact to the individual currency, this would bring more increased value to the respected currency. Bank of Canada is raising interest rates. That would bring up the value of the Canadian dollar, as you're overall having less money supply accessible within the markets, and less and overall demand increasing on a global scale with rates rising. Like, for example, if the Federal Reserve was not raising interest rates at all, and all of these other countries were, they would all be a lot stronger against the dollar. But because the US dollar on a global scale holds this position with how global economies have been set up, we have this sequence of events take place. So the central banks hiking interest rates, that's all step one that leads to these individual currency strengths. But against the Japanese yen, all of these pairs are going to be primarily bullish. Against the dollar, they're going to be bearish, because the US dollar is the world reserve currency, global business currency, and that just holds a lot more weight individually. Now, the central banks actively hiking interest rates, besides just having this direct impact to obviously their respected and correlated currencies, what it also does is decrease overall investment activity and economic activity. And on top of US dollar going up in value and majority of global asset classes being denominated or traded in the dollars in terms of exchange, dollar domination also takes over. So you have this impact now where even though the British pound and Bank of England might be hiking interest rates to bring the value up of the British pound and start to combat inflation in the UK, the Reserve Bank of Australia may be doing the same. The Bank of Canada may be doing the same, but dollar domination, as Sebastian gave a good example in his dollar domination webinar of the dollar vortex, because of the position it has in the global economy and how so much is essentially rooted and connected back to the dollar, it swallows everything up in this vortex. So you have this combination of factors of global central banks raising interest rates from the majority aspect when you're looking at major central banks. This decreases investment activity from an institutional perspective because it's less likely with higher interest rates that institutions are going to be taking out loans, business to business loans, less corporate investment, less corporate activity and institutional activity overall. And you have the US dollar value skyrockets and a lot more demand in the dollar because the market sentiment, the order flow shifts. When you had very low interest rates, not major economic fear, the central bank staying in an accommodative phase, not having the primary focus of bringing down inflation, all of the investment activity, all of the liquidity from a market perspective, that's all going into risk asset classes or other asset classes overall. All the demand during the period of accommodative phases or stimulation phases is going to be in housing. It's going to be in commodities. It's going to be in the stock market. And you're going to see dollar extremely bearish during that time. But you have a complete shift when the monetary policy is shifted. So less economic activity, investment activity dropping from an institutional perspective, dollar domination with Fed rate hikes, and that being the world reserve currency, you also see more demand in the dollar and less demand in all of these other asset classes. So when you understand that and you bring that information together here, and for example, we're looking at gold, right? You can see primarily for almost the last 9 months, ever since we peaked these 2000 highs, we've been a lot more bearish. We've gone from 2000 highs all the way into almost roughly 1600 lows here, tapped like 1615 last week, right? The main reason for this is a lot of people are coming to me, and especially when they're looking at gold, it makes sense when I explain to them, hey, housing is bearish, interest rates are higher, less possibility of investors and smart money pooling into the housing market. Same thing with commodities. But with gold, they keep pulling up, but gee, inflation's so high, recession scares are so large and so forth. It doesn't matter. When we're in this type of economic climate and these types of conditions, majority to all asset classes are going to be bearish. None of these asset classes during this current economic climate and environment are favorable for smart money market makers to be investing into, right? You have to look at that as soon as the Fed started to switch out of their accommodative phase and start to switch monetary policy to combat inflation, that inflation has already been priced in during the pandemic and during the Russia-Ukraine tensions that came into play. Inflation was priced in. You have no more free money era or stimulus being provided by the central bank, no more asset purchase program. And as inflation is priced in and the Feds are switching their monetary policy, you have all-time high prices hit. Very high prices, less investment activity and institutional activity with interest rates going up. Interest rates going up, which is a negative bearish factor for gold. Dollar value starting to increase and the dollar vortex swallowing up anything against it during this period of time. And way more demand in the dollar as majority of asset classes are bearish. So we've been waiting for this historical repetition of coming down into the 1680s and also starting to break the 1680s and even having a bearish run potentially on the higher time frame now, which I can see that we could come down into the 1400s, 1500s before we possibly see any reason for gold upside, maybe into next year if we have Taiwan tensions pop off. But other than that, geopolitical tensions have not held more weight than the cartel of the currencies monetary policy. And we haven't seen any of the geopolitical tensions so we haven't seen any of the geopolitical tensions come to the table yet lead to a Fed pivot or lead to a Fed change in monetary policy to start pumping the markets again. Even with Russia-Ukraine tensions, the US, even with all the political drama, sanctions, all of the disputes from a diplomatic perspective, they still didn't get involved from a military perspective, and it didn't lead to the Feds shifting out of their monetary policy positioning. Taiwan and China is all noise so far. The US is not actually physically involved. It's not leading to the Feds pivoting out. Recession scares are growing, doesn't matter. Fed's primary mandate is bringing down inflation. Bad data and declining economic data is not leading to the Feds pivoting or shifting out of their monetary policy sentiment. So that gives us a lot of information to understand that we can clearly see a shift in order flow with very logical catalysts that make sense. All-time high prices hit, high prices, right? Rising interest rates. No more Fed APP or asset purchase program. Less institutional investment activity because you have higher rates, less lending, less of taking out those loans and reinvesting it into the stock market. US dollar domination. Historical repetition of what we've seen 2013, post-2008 crisis. During the 2013 period, this major downside was attributed to Bernanke's taper tantrum, where they had very aggressive tapering, followed up by rate hikes 2015 and so forth, that got priced into this entire downside move, going from 1,800 an ounce almost to 1,100 there. And no geopolitical tensions or fear. Inflation priced in. No new FUD, right? Now, the beautiful, interesting thing is these reasons here if you understand the fundamentals, holy, this is from way back here saying don't fight the Feds and all that, keep buying the stock market when we were playing that pooling up there. That's pretty interesting. That's from a long time ago. This is the same exact reason: all-time high prices, rising interest rates, no more Fed support, less investment activity, dollar domination, historical repetition of what rate hikes do to the asset class, except the no new FUD. That's obviously for gold individually as a precious metal safe haven, but these are the same reasons why the stock market is bearish. These are the same reasons why oil has turned more bearish over the last 6 months after peaking 130 highs. And except instead of no new FUD down here, which is still true because you don't have any more war tensions, we can also put decreasing global demand as recessions are underway globally. Does that make sense to everybody or no? These are the same reasons in inverse when you come to the dollar here. From the lows of why it's so bullish. You have historical low prices hit. This is the reason why dollar has been so bullish. right? So when we're bringing that information together to the table now, even though we may have had some volatile periods, pullback phases, is there any reason for us looking at gold here to switch out of our macro higher time frame bias? Is there any reason for us to be looking for higher time frame buys back to 2000 or looking for a key buy area here somewhere? No, we should primarily be looking for some pullbacks to the upside, maybe for generating more sell side orders, especially for the new quarterly period, but primarily be looking us to continue our higher time frame information advantage of more bears. GU, dollar domination, more bears. Euro USD, dollar domination, Fed rate hike cycle holding the most weight, dollar vortex swallowing everything up in its path. Emerging countries suffering so much, they're doing currency interventions. Even larger countries are feeling the heat where they have to do rare events that they haven't done in years, such as Japan's currency intervention, or UK performing a bond buying program amidst an active rate hike cycle, which I explained in the educational webinars last week as well. UCAD, we have no reason to be selling UCAD. We had a very strong support at this demand zone, dollar domination, oil turning bearish. CAD rate hikes are not going to over mask the US dollar strength, and the Fed rate hikes on a global scale still have high points to revisit. US 30, monstrous liquidity grab wick, which was obviously that short-term bear market rally. Quarterly and monthly candles flip bearish here. Very aggressive bearish price action, canceling out this bullish price action even more aggressive fashion. Less investment activity. Interest rates are still going up and staying up. VIX is starting to break out. Dollar domination still active. And recessions are actively happening as well, where these situations are just going to worsen. We have no reason to be buying into the stock market, to be buying gold. You have no reason in your day-to-day life to be looking to invest into real estate market or to be jumping back in crypto. Not yet. I don't care if people start telling you dollar cost averaging. I don't care if somebody shows you a good price on a house that it dipped a little bit. It's going to dip more. Does that make sense to everybody? And same thing when it comes to trading. I'm not looking to be day trading or long-term trading or buying stock market. I'm not looking to be buying gold unless we have fundamental reasons to do so. What would be a fundamental reason to go back into the stock market or to go back into housing or crypto after the aggressive crash or aggressive downside, which may last months, may last a year and a half, where we just have continued bear markets and recession markets? Or if the Feds ever pivot, which if the Feds pivot, all of these asset classes will go bullish for a period of time, but it will just lead to a larger bubble pop in the near future. Does that make sense? Like, let's just say the Feds say, you know what, recession scares are too large. We have all these geopolitical tensions going on. We've brought down inflation a little bit, but the markets are suffering too much, and all of this, and the economy suffering too much. It needs that extra jolt. We're going to pivot. We're going to go back to cutting interest rates to zero and going back to an accommodative stage. That would be fantastic for investors, smart money, the market makers. They'll jump back into the stock market. Crypto will go bullish again and so forth. Housing will go bullish. And maybe you can sustain that movement for like maybe another year until something really breaks, because inflation will still be through the roof again if you continue stimulus. But that's just talking about scenarios of what we would need. We either need a crash and reset in prices, and then the recovery phase where we start buying from the lows on these asset classes, post-crash, post-recession, late recession, right? Or you would need Fed to pivot, central banks to completely pivot, stop hiking rates, go back to stimulus mode. If the Feds come and pivot, I'll be the first one to tell you, damn, Feds are pivoting. They're completely shifting their monetary policy. I'm going to buy Bitcoin and hold on to it. I'm going to buy it back into the stock market. I'm going to start selling off the dollar. We'll buy back in gold. Inflation's going to go back up, and we'll play that. We don't have those reasons. Does that make sense to everybody? Do the fundamentals make sense? Why the dollar is bullish, why gold is bearish, GU bearish, Euro USD bearish, UCAD bullish. stock market bearish. It's no different than last month's fundamentals with the higher time frame analysis, or the month before, or the month before that, or the month before that, or the month before that. We just have to reiterate it, repeat it, just so people really get it in their brain and they can see the progression of it over the last 6 to 8 months. Does that make sense? So now when we're looking at gold, right? When you're looking at the monthly time frame and overall order flow. Obviously, gold from a historical perspective is bullish and has been overall increasing in value. But it's very, very common to get these corrective phases, especially after such large successive bullish runs, right? Which is completely normal and completely understandable in terms of market and economic cycles. Even when I'm looking at gold from these low points here and just mapping out some structure, even if we got a retest and over maybe the next months, we started to drive down into the 14 and 1500s here, we could easily, if we get the geopolitical tensions, Taiwan invasion during that period, China wants to buy up gold from the lows, you could easily see us turning back bullish months, even year later, late 2023 into 2024, Taiwan invasion, World War III. But anyways, what I mainly want to talk about is the potential of us at least revisiting this market structure point and key price points of interest. So just from a technical order flow perspective, without understanding any of the fundamentals, what we can see is a technical double top failure to break above $2,000 an ounce. Without understanding any of the fundamentals or understanding what's inducing this movement of why we're failing to break or why we're turning bearish, this simply tells us that we don't have enough we don't have enough buyer order flow to break higher, and sell orders are more dominant with buyers liquidating positions out, creating more bearish downside movement. Now, we understand that this was with Russia and Ukraine tensions getting priced in, inflation being priced in, and the Fed shifting into a rate hike cycle. Here, it was all of the 2008 GFC tensions and uncertainty getting priced in, and then no more buy-side liquidity or catalyst to break higher, and then the 2013 Bernanke taper tantrum. As soon as you start to break that double top neckline, you have a very, very nice bearish run down to revisit higher time frame bullish structure until you have reasoning for buyers to come back into the scene again. So here, after the 2008 GFC, we had a retest of all-time high prices. Buyers get to liquidate and offload from all-time high prices and still get to make their bag. Shorts and sellers get to dominate from better high prices of interest, and the fundamental catalyst of the 2013 taper tantrum, which is a very aggressive tapering phase leading into the rate hikes, 2015 signals, 2016, and so forth, right? The fundamental catalyst during that period of time of late 2012 to 2016 was bearish on gold with no real reasoning for any global uncertainty and doubt and so forth. Yes, in 2016, we had some Brexit uncertainty, but even that 2015, 2016, even that wasn't enough to take gold back to all-time highs. Yes, Brexit brought some uncertainty, but it was primarily impacting Euro and UK, having some minor ripple effects on global countries through business and through import and export contracts and so forth. It wasn't something as globally impacting as the 2008 GFC or, of course, the 2020 pandemic. But then we started to get Trump coming into play. Then we started to get Trump inducing the trade wars and being the tariff man, starting to go after China. And then, more importantly, the pandemic, almost World War III with Iran, if nobody remembers when the Iranian general was assassinated as Trump was still in power. But the main reason for the upside back here in the shift was the pandemic and then the accommodative policy of the central bank. Remember, It's not just GFC here that leads to the huge surge in price. It's also the accommodative policy of the central bank. Low interest rates, more investment activity, more demand into gold, easier money from an institutional perspective, inflation rising during this period of time as well. Except the catalyst to induce that monetary policy was the global financial crisis, right? Here, the catalyst to induce that monetary policy of having very low rates, money pumping into the markets and asset purchase program was the pandemic that led to global lockdowns and so forth, right? Now, all of those catalysts in green are coming to a full, complete shift. Instead of at that time having very low prices on gold, starting to have fundamental catalysts of fear come in with the GFC and and here being the pandemic, the Fed shifting into their accommodative policy stance and keeping interest rates at zero, and then all of that leading to this entire move getting priced in at 2,000 an ounce here. Here is roughly at like 1950. Now we have the inverse. Here we had very high interest rates. No, sorry. Here we had very high prices, potential shift into the interest rate policy, where this was a aggressive taper tantrum. Here was the tapering signals and shift into active rate hikes. And then the fear and uncertainty gets faded out, doesn't hold any more weight. And that macro information advantage of the shift into a hawkish monetary policy by the Fed, it held weight for almost 2 to 3 years after, right? So what we can anticipate is if there's no Fed pivot, no global new FUD, right? No World War III, no China-Taiwan invasion, and so China invasion of Taiwan and so forth. If there's none of that, then we'd have a higher probability of, yeah, price action may get a bit sporadic. You might have aggressive pullback phases. So what? We're used to that with gold. Overall, we should be making our way down, having deeper corrections, gold coming into the 1500s and 1400s. As long as there's no reason for Feds to pivot and shift out of their monetary policy stance, as long as they continue hiking rates and keeping interest rates up for an 18-month to 2-year period, as they stated, as long as dollar continues bullish on a global scale, yeah, we might get some aggressive bullish pullbacks, maybe with countries' currency interventions, short-term bad economic data as recessions are only going to worsen, minor geopolitical tensions, but nothing's going to overmask the macro information advantage here. We would need World War III, actual invasion of Taiwan, global lockdowns again, reason for Fed pivot. Does that make sense to everybody? Charles Cook, no, it doesn't to you. You didn't even know what market sentiment meant when I asked you today. So Charles, don't lie. You still got a lot to learn. You're a new member from last week. You had to go to Investopedia to find a sentiment definition that was from the stock market, not related to what we're talking about. Don't get ahead of yourself. Take it step by step. I guaranteed a lot of what I said to a new member is Chinese or a different language. Right? You too, Delogardi. You just joined the service as well. You were the guy who just magically transformed in banter within a 24-hour period, you think. Don't think you're the same. You're in the same boat as Charles. Why do you think you're different? You're in the exact same life raft. Okay? Now, you shouldn't even be in this webinar, Delogardi. You don't understand. You don't understand. You guys don't get it. Why are you joining a higher macro analysis webinar when you don't even know a lot of these concepts? Okay, what's a Fed pivot? Should I get the Jeopardy music on? The wait music? What's a Fed pivot? Charles Delagardi. What's a Fed pivot? No, Google it quick. Go Google it. Not just if they lower rates. It's more than that. Yes, Charles. Good job. This other guy said it's too difficult. Charles got it on the money. Good job, Charles. Answering that pop quiz with pressure in the spotlight. So good job there. The other guy, you just said you're understanding everything, and then you said this was too difficult. No, you don't know, Delogard. You guys are funny, man. Okay, so the reasons why gold is bearish is the same reasons why GU is bearish, Euro USD bearish. It's the same reasons why Bitcoin is bearish. And holy shit, this Bitcoin it was Bitcoin higher time frame chart is nuts. Holy, imagine all the people trapped in buys here. No, well, yeah, you're right. Crypto mans are in straight shambles. At least gold, yeah, the stock market in gold is having a correction, right? But at least, like, come on, gold's still like higher time frame historically bullish though. Even if gold does our correction of 1400s, like we just been playing this bear market cycle. We were playing these gold bulls during the pandemic in Russia and Ukraine, just like we would have been playing it during the GFC, but we've been adapting to the bear market cycle. But at least gold doesn't look like a rug pull. Even everybody talking about the stock market, at least the stock market doesn't look like a rug pull. This is only showing us from 2018. Let me go to a more historical chart here. This is better, right? At least the stock market doesn't look like a rug pull. Bitcoin, what the hell? What the hell is this? Shit, man. Another 10K drop and we're back to historical lows, back to, you know what I mean? Back to prices before everybody knew what Bitcoin even was. That's madness. This looks like it's coming down to 13K still. 100% is coming down to here. 100% with the accumulation of sell side liquidity here, dollar domination, bearish. Maybe you get a quick upper wick. This is just gonna melt down here. But anyways, what was I saying? The same reason why I just explained to you higher time frame from a economic and fundamental reason why gold is bearish is the same reason why these other investment vehicles and asset classes are bearish. Sorry, crypto mans, Bitcoin is nothing different than bonds, than stocks, than metals, than commodities. It's just an investment vehicle. It's an asset class within the financial markets. It's not a currency. It's not decentralized. It's not depegged from the US economy or financial system. It's perfectly intertwined within it. It got its own new little place in the asset class area. You know what I mean? This is the same reason why oil has had a massive correction over the course of the last, obviously we know oil from a historical perspective, but just the same reason why it's been bearish for the last 6 months. This is the same reason real estate ETF. This is the same reason why real estate sector has been dropping over the last 6 months as well, completely wiping out all the pandemic gains. Isn't that crazy? Is nobody else interested by that? That one major macro information advantage is the driving factor for majority of asset classes within the financial markets. Bitcoin, oil, real estate, stock market, gold, any currencies against the dollar, emerging countries, all getting slapped by dollar domination, that dollar vortex, as Sebastian calls it, and induced by the Federal Reserve rate hike cycle and single mandate policy of bringing inflation down. Right? There's no reason for us to be buying into any of these asset classes, whether it's long-term investment, day trade. Yeah, day trading, if we adapt to some pullback phases, obviously. Scalping, you take some short-term buy scalps when gold's in a bullish pullback phase for a week or two. Yeah. But from an investment perspective, swing trading perspective, no way. Okay. Now, as I explained, global central banks are raising interest rates. So a lot of people come to me and they say, gee, yeah, obviously the Federal Reserve is raising interest rates. I can clearly understand why the dollar is dominating, dollar so bullish. But how come the British pound so weak against the dollar? How come euro is so weak against the dollar? Why is AUD so weak against the dollar? They're all actively raising interest rates as well. It's because of the position the US dollar holds on the global scale pretty much ever since like the late 1950s, 1960s. It has went at an accelerated pace after every single financial crisis. After every single financial crisis, from like Black Friday in the 80s to the dot-com era crash to the 2008 GFC to the pandemic, everything gets closer and closer tied to the US dollar as the global financial system grows and expands. It gets closer integration to the US dollar, more dependability on the US dollar, because countries' reserve assets of dollar just increases as more dollars get pumped into the market and supply gets increased on a global scale. Global business is still denominated in US dollars. Oil is still called the petrodollar. It's still sold in the petrodollar. They call it that for a reason. So it holds that weighting, right? When you're looking at a currency pair, you have to understand we retail traders trade these currency pairs. Institutions don't give a shit about the movement of these currency pairs. Institutions, politicians, they give a shit of their individual currency value against the dollar, but they're not looking to see if Euro USD is bearish overall at the currency pair. They're just looking at Euro, which is standard they're just looking at the Euro, which is automatically displayed in price against the dollar, right? Whenever you see in the newsroom, Euro dropped 5% and you just see Euro, it's automatically assumed to be against dollar. They're not talking about Euro JPY. They're not talking about Euro AUD. They're not talking about Euro CHF. Whenever you see in the newsroom, British pound, sterling drops 0.5%, drop 1%. Euro dropped 2% during the session or over the last day. Euro continuing down. In the newsroom, those headlines are automatically assumed to be against the dollar. The global markets in scale, they're not looking at JPY pairs, CHF pairs. Does that make sense to everybody or no? We as retail traders trade these currency pairs and crosses. Right? So when you understand on a global economic scale how much weight the dollar holds, if you have two countries actively raising interest rates, the currency that's more important on a global scale is going to take over dominance, to put it in simple terms. And US dollar is the leader of global economies, whether people like it or not. People can say US economy is corrupt. I can say the same thing, that the US economy is very corrupt. The whole global financial system, every political system, every institutional system down the line is corrupt. You can say, oh, US economy is declining. China's going to take it over in the future. Crypto is going to destabilize the dollar. You can say all these things. Dollar is still the leader, still the king at the top right now. Like how Sebastian was showing the example of Mike Tyson. Unless you actually get the event when Mike Tyson gets knocked out, he's still the champ. Right? Can it come in the future? Maybe 5 years from now, a decade from now, maybe, sure, anything can happen. But right now, dollar's still the heavyweight champ sitting with the belt. With no contenders, nobody even ready to take over. Does that make sense to everybody? So there's no reason for us to shift out of our Euro USD seller bias. We're breaking below historical lows. We're clearing below 2020 pandemic points. Huge smash of that level, well below the parity point, and it's not looking like it's slowing down anytime soon. Right? Same thing on GBP USD, bearish structure, bearish price action, bearish fundamentals. UCAD the inverse, US 30 bearish as an asset class. It's going to be the same thing when we look at the weekly time frame, whether you're looking at the structure, price action, and if we were talking about here, potentially seeing a pullback phase, which I'll talk about in the market update webinar as well, but we can easily see gold pullback phases to 1700s just for the new quarterly and new monthly period. Very, very common, as I explained to you guys in the trade room last week, and we've talked about in other higher time frame webinars. We could adapt to a month-long pullback phase here. Who cares? We'll set up better sells and have beautiful ranges to play to the downside. If we just start breaking below these candle body lows and lows, we'll just continue the melt. We don't care. Right? Yes, GBP USD, Euro USD, similar idea. We might have a little bit of a weekly pullback phase for the new quarter. Doesn't matter. We'll play that pullback until we jump into better, higher time frame sells. Euro USD, same idea. Euro USD doesn't even look like it's going to give a pullback, but even if it does, to even come retest previous lows, no big deal to us. If we just continue bearish, even easier. I actually prefer, after aggressive downside movement, after lows are printed, I personally prefer pullbacks. Even on the higher time frame, if the pullback lasts a couple of weeks or a month and a half, I don't mind. Once it gets faded out, you're going to have impulsive moves back to the lows. One weekly candle bring you back down to the lows or even lower. Huge ranges to play with market structure. Right? Now, that all makes sense. We know why dollar's bullish. We know why the equity markets are bearish. We've been playing stock market sells since 36K down. We've been playing dollar domination buys literally since 92. Ever since we had this bit of a consolidation, failed to break, shift into the tapering sentiment and rate hikes, with potentials to come into 120 still. We've been playing gold sells since April 2022, 1900s down. Same thing GU, same thing Euro USD. We have no reason to shift out of that bias or sentiment yet, right? Now, the only currency pair that we have to explain that's a little bit different is GJ. But higher time frame macro information advantage on GJ has been bullish overall. We've been looking for this same type of historical repetition. As we had these historical low prices hit, we had a dovish Bank of Japan come into play in a further aggressive fashion with unlimited bond buying program. And Bank of England also turned hawkish into 2022. You can see, even though that monstrous volatility that we saw, with that aggressive liquidity grab and huge quarterly price setup, that we're still maintaining above key price points of interest, and that quarterly candle closed with a massive, massive rejection wick, and the body didn't even engulf the previous bullish body. The sequence of events that is leading to the macro higher time frame bulls is still very much valid. Bank of Japan, are they raising interest rates? Are they stopping their bond buying program? No. Yes, we had a little bit of currency intervention, but short-term currency intervention isn't going to mask or overtake what? Sometimes stupid questions completely kill my train of thought. I'm trying to explain so much high-level information. 120, 130, what are you talking about? You think we're coming back to 120? What a retard. Forex Street. What a dumb shit. You think we're just going to magically come back to 120. How do I feel about 120 buys? We're going to come back down 5,000 what pips? What kind of stupid question is that? During this higher time frame, what you guys are dumb as fuck. Some of you guys are dumb as shit. Holy fuck, man. That's insane. The IQ levels is in the modern age is straight insane. Delogardi's getting annoying. This other person's a straight retard. Wow, that's crazy. What do I think about buys at 120? That's when we're currently sitting at 161. Holy. Some of you just beg to be retarded. Some of you get on your hands and knees and pray every night. Keep me a retard, please. Please keep me dumb as fuck. Please keep me clueless. I'm going to wait for GJ buys at 120. Why? I don't know. Maybe we'll go down there for fun. Last time we came down here, we needed financial crisis. But I don't know. 120 buys. Shit, man. You guys are stupid. My God. Anyways, man. GJ is still macro higher time frame bullish with still high target points for us to revisit. As long as we still respect that demand zone at the high 150s here, even if we get a partial range fill of that quarterly wick and we still respect some of that intraday market structure, or of course, if we start flipping bullish and trading above these highs, still a lot of probability for, I sort of want to end the stream. I don't really want to do this anymore. I don't even really want to explain anything anymore. This shit gets me so demoralized that people got these brain capacities. Makes me sad in my heart that you could be giving so much information every single day, every single week, and people just ignore it. They don't learn. They don't spend time studying. Like, you're sitting in this whole webinar, we're explaining stuff about Bank of Japan, the reason why we've been bullish. We've been playing these buys for the last year and a half. Some retard says, what about buys at 120? Crazy, man. Crazy. But yeah, GJ higher time frame, still bullish for the same reasons as the last macro higher time frame webinar. We had a very aggressive quarterly liquidity grab here, potentially just setting up for the next quarter, still maintaining bullish market structure, bullish chain of events, didn't engulf that previous quarterly candle. Monthly time frame is still very bullish as well, where you can see how that candle closed with indecision, very weak body. We start shifting out of some of that intraday structure. We get a partial range fill here. Still expecting buys to the upside, very similar to some of these sequence events we had during the 2012-2015 run. Macro higher time frame information advantages of central bank monetary policy is still holding the most weight. Any geopolitical tensions of fear have been very short-lived. Bad economic data is usually very short-lived. Even rare historical events of tax cut plans from the UK, the same time of Japanese yen currency intervention, also very short-lived against the macro rate hike cycles of the Bank of England or the dovish cycle of interest rates being in the negative of the Bank of Japan. We're still looking to play asset class bears against the dollar, gold bears, higher time frame, GU, Euro USD, US 30, oil, crypto bears, UCAD bulls. We're still looking to play dollar domination. We just have to keep in mind the new quarterly period potentially having some pullback phases or price setups before continuing with our higher time frame trends. Higher time frame trend and fundamentals, bearish gold, bearish GU, bearish Euro USD, bullish USD CAD, bearish stock market, bullish GJ. I'm going to save and upload this, and I'm going to go shoot myself in the head. I'll see everybody later.